In this video, we're going to go ahead and talk about a negative income tax and kind of how that plays out, and then just touch on very briefly some of the implications of that and the change in incentives that a negative income tax structure can create. So basically, a negative income tax structure is that for moral reasons, for political reasons, we say that we need some guaranteed income level. And so we say we have this guaranteed income level, which I'm going to abbreviate as GI. And then if you fall below that guaranteed income level, we're going to we're going to give you money back. We're going to give you a negative income tax. So your income, so I'll use I for your income, is equal to the guaranteed income plus, we'll call it what you made. So we'll use we'll do an M here for what you made, and I'll just write that because M's kind of weird. What you made. And then so we are going to take the guaranteed income and subtract that, and then we're going to multiply that entire thing by the tax rate. So T here is that's the tax rate. And GI is guaranteed income. So what we're saying is if you make less than the guaranteed income, the government's going to end up paying you money, and they're going to pay you more and more money the less and less you make. So we'll see how that plays out with a couple examples. So let's say that the guaranteed income level for the person in yellow and the person in orange is $5,000. And let's say for both of them also the negative income tax rate is 50%. So it's 50% in both cases. Now let's say that the person in yellow makes $4,000. And the person in orange makes $2,000. So just now we're just going to go ahead and plug this into the formula over here. Their income for the person in yellow is going to be the guaranteed income, 5,000, plus then 5,000 minus 4,000, and all of that times 0.5. So their income then is going to be 5,000, and then 5,000 minus 4,000 is 1,000, times 0.5 is 500, which is 5,500. Now what about this person in orange? Well, their income, they're going to have the exact same thing, except this 4,000 here is going to be replaced with a 2,000. So give me one sec to write that. Plus 5,000 minus 2,000 times 0.5. And so this is going to be 5,000 plus 3,000 times 0.5, which is 5,000 plus 1,500, which will be 6,500. So the person that made $4,000 ended up getting $5,500, and the person that made $6,500 the person that made $2,000 ended up getting $6,500. So that seems kind of messed up, right? The person that actually made less money that year ended up getting more. So that's one of the reasons that this negative income tax has kind of fallen on deaf ears as far as economists go. There's a couple other reasons that I'm not going to get into here, but simply for you guys, you need to know kind of what it is, be able to talk about it, and then be able to work through these kind of calculations. So I don't think that I need to do any more on that. If I do, let me know, but I think that should do it.